People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, you've been kind of putting that off, you don't know where to start, you've been hearing Charisse and me on the radio for over a dozen years now. Why don't you give us a call and sit down and just start and just say, okay, here's what I've done with my retirement, here's what I've saved, and I don't know where to go next. So that's usually the way these things start, and we would love to have that conversation with you. You can also start at 833-368-3680. All right, I'm gonna go down memory lane here just a little bit, Charisse. Financially speaking, what did you learn from your parents? Okay, one of the things that I saw my dad do is sit at the kitchen table and write out bills, okay? One of the things that he did each month was he did the envelope thing. He had an envelope for the mortgage, an envelope for the utilities, an envelope for church, and there was another envelope for fishing money. I always remember that because we always would go on our fishing trips. That is called cash stuffing. And, you know, when we got apps and we got Quicken and we got all these things, that kind of went away. But apparently, Charisse, it's making a comeback. There are people now that are using that again because when you hold on to cash, your money gets more real. That's why they always use chips out in Las Vegas and not cash. So it becomes a little bit more real and people pay a little bit more attention. So I don't know. Maybe that's all coming back now. But I want to take that idea here and talk about when people come in for a meeting with you. There may be some places in their life that is overstuffed. Mm-hmm. Okay. They come in and maybe, I don't know, maybe it's the 401k or whatever. What do you see that you look down and you go, okay, there's a little too much here. This is a little overstuffed.
So I would say the things that are stuffed the most are your 401ks and IRAs. You have saved so much money in your 401ks and IRAs that eventually it's all going to be taxable, but you did get a tax write-off in the meantime, but you're going to be in the same tax bracket or likely a higher tax bracket when you retire. There's no guarantee to any of this, but taxes tend to go up over time. And as debt gets higher, that's what we see. So we want to make sure if you're stuffing your 401k, always stuff the 401k up to your match from your employer, but then you can stop stuffing that 401k and then potentially go do a Roth IRA, maybe even open a brokerage account, because these are better tax strategies for your future. And then if you max some of those out and you're like, I want to go back to the 401k, then put more money in the 401k. So be careful what you're stuffing and be diligent, because you can't see it now, but I see it for you in the future, the tax problem and that ticking time bomb called your 401k and IRA that you're going to have in the future. So that's one thing that is definitely overstuffed. Some people, number two, are overstuffed with company stock. So you're working with a company and they give you all this stock at discount and they retire. And I find that 75% of their total portfolio is in the stock. That is not diversified. So we want to diversify that and slowly exit all that stock, because what if something happened to that company or you needed income that year, you're retired and it goes down. And the rule of thumb is financial conventional wisdom, do not sell anything that has gone down, right? That's how we run out of money. Yet you have to, because you got to pay your bills. So we want to be very cautious on that strategy. The other thing that's stuffed is how much risk you have. People come in here all the time. We do a portfolio x-ray and they find out they can lose 35, 45, 55% in their portfolio, and they're 60 or 55 and they're just like, oh, I don't want to lose that much money. money because I need my money, because you're done that accumulation phase of your life. And now you're going into decumulation where you're still going to have growth, but now we're living on our income. So investing is different. So don't overstuff your risk the closer you get to retirement. So I feel like that is a key part to also remember.
Well, one of the things that is very common is we go into retirement and we are going to have a big 401k. And that 401k comes with a big tax bill. And that's one of the things that we've got to kind of iron out here. And there are solutions to that, which is what we're going to talk about next. But in the meantime, what in your portfolio, your holdings, what you've done for retirement, might there be a little too much? If it's a piece of pie or a big pie, do you have too much of your pie in one place? Let's find out. We'll do that analysis for you. We call it a portfolio x-ray. Give us a call, 833-368-3680, 833-368-3680, or our website, which is ZinniaWealth.com. All right, so that 401k, let's continue that conversation here. You're overstuffed. Most of what you have is in a 401k. The solution that we talk about all the time is moving money from an IRA or a 401k over to a Roth. It's called a conversion. Well, the Wall Street Journal just did a story about the benefits of the IRA to Roth conversion, and they said that if you can get yourself into a lower tax bracket, which is what this does, it can extend your money by up to 7 years. Wow, that is significant, Charisse. Have you seen that kind of an impact when you're doing conversions for people?
When you're rolling an IRA over to a Roth, on average, we see tax savings huge, not just in the next 10 years after you've already rolled these dollars over, but for the next 20 years in retirement. And then what we also see is that when one spouse passes, the surviving spouse goes into a higher tax bracket, yet their income is lower by 25% because we just lost a Social Security check and hopefully not a pension because that number could be bigger. And yet we're paying sometimes double and triple more in taxes, no joke. So we want to protect from the tax man and the surviving spouse. Now, the one thing that people miss out on is not always saving for the surviving spouse and the taxes there. It is the beneficiaries, because when somebody passes away now, you can no longer stretch your IRA, stretch it to your kids for the rest of their lives, and then they can stretch it to the next generation. Your beneficiaries have to cash these IRAs and 401ks out over 10 years. That means they're paying full-blown taxes on all this money. And then when they get that money, they're going to reinvest it in a brokerage account, and then it's going to get taxed again. So when you roll IRAs over to a Roth, all those dollars in the Roth go to the kiddos tax-free. And when we put together the tax plan, people save hundreds of thousands of dollars in taxes, sometimes millions of dollars. It gets close to millions, I'll be honest with you. And on top of that, when you roll your IRAs over to Roth, the legacy that's left over for the kiddos is higher. Mm-hmm. That's the craziest part about it. So understanding your growth strategies and your income strategies, but it is uber important to understand your tax strategy, because those are your dollars and you don't want to give them back to Uncle Sam if you don't have to, maybe early on, but later on, if you live 30 years, it's pretty pivotal when it comes to how much you can save in taxes. And again, we have no guarantee for the future and where taxes are going to go. And I know Donald Trump is talking about, hey, because tariffs are going to be so great, we're not going to have income taxes in the future. I don't see that happening.
Mm-hmm. Yeah, I think it's really important to know and look down the line and say, okay, have that math done by Charisse, and what kind of a trouble am I going to have? We did a story not long ago about a 90-year-old guy who was doing very well. He had $1.5 million in his 401k at age 90, so congratulations. But his problem was he never did a conversion, and now his RMDs are like $125,000 a year. And he's like, what am I doing here writing these big checks? And he was really at a loss. And the answer to that one is, you should have had this conversation with Therese about 30 years ago. So don't let that go by without at least doing the math on your 401k. Wouldn't it be a great position for you to be in at age 73 or at age 75 when Uncle Sam comes a-knocking and says, pay up, and you say, already did it, and you don't have to worry about that anymore? that's a good day. Give us a call. Let's talk through that. 833-368-3680. 833-368-3680. Or our website is zinniawealth.com, Zinnia wealth.com. Down at the bottom of the page, there's a gold box that says complimentary retirement consultation. That's exactly what it is. It's a meeting where we sit down and just talk through your retirement to find out if we can help. We will do that for you at no charge. Give us a look on our website. All right, so there's a lot of rules of thumb out there that we have blown up over the years. And there's a new study out there that says many of these rules retirees aren't buying into anymore. For instance, only 35% of retirees say they believe in the 4% withdrawal rule. Only 53% say that idea of 100 minus your age should be the amount of risk you take. And only 64% of people say now that retiring at 65 is something that they'll do. More people are waiting much longer to retire. So if your financial advisor is still using those rules, Cherise, should you move on? I would think so.
So let's talk about myth busters and abandoning these old rules. So there's a 4% rule out there that was created in the 90s when the Dow Jones grew over 1,000% from 1980s to 2000. And right smack dab in the middle, they created this 4% rule because the market was blowing up. So what happened in the year of 2000, this 4% rule says if you don't take more than 4% from your portfolio, you will never run out of money. Well, that was blown away because in 2000, 2001, 2002, the stock market took a 33-month decline. Like that eroded portfolios. I'm talking about tech bubbles, Enrons, you name it, planes crashing. It was a horrible time. And then it took 5 to 6 years for that account to get back to even. And so those people were still taking 4%, but they had to take a higher percentage because their account values, their 401ks turned into a 201k because their $1 million got cut in half to 500,000. And if you had to take 4% when it was at $1 million, which is 40 grand, and now you're at 500,000, you're taking a much higher percentage. So people never got back to even. And a lot of people actually went more conservative so they could never do it. So people ran out of money, or just some people changed their lifestyle, which is awful in retirement because they had to live off less because they didn't have as much. So we don't want that to happen. So I don't follow the 4% rule. I follow our withdrawal and income strategy, which we'll talk about in just a couple of minutes. But the number 2 myth buster, they say, okay, this is how much you should have at risk. Take 100, the number 100, subtract it by your age. So if you are 60, you subtract that by 100, what you have left over should be in the risk part of your portfolio. I still like that rule. That's a baseline rule to start to follow, depending on the strategy your advisory firm is putting together for you. If you're going to go with a Fisher investment strategy, follow that rule because it's a cookie cutter strategy and it's a 60-40 portfolio, which I am not a fan of because it's not your parents and your grandparents' retirement anymore. There's new things that you can be doing to keep up with the times, and old school's old school, so we just don't do that. We might have a little piece of your portfolio in 60-40, but a very little piece, I will add at that. So I still use that as a baseline strategy, but I'll tell people why they could actually take more risk and have more money in the stock market than 40%. Or some people I'll say, hey, no, this is perfect because of your income that is needed for your lifestyle. So it is not cookie cutter in our office, and it's always so different depending on the household. Now, I think the last myth I want to bust is the new thing out there is people think that they have to live longer than 65. They can no longer retire at 65 when they can get their Medicare and they get their insurance covered. And that is not true. Like anybody who's retiring at 65, I think it's silly today. When people come in and sit down with us, we are building their withdrawal strategy, their income strategy. We're taking inventory. We're looking at all their incomes, their social security. So they get a pension, maybe they don't get a pension. So we're going to create a pension plan for that person, most likely, not all the time. And then we start building out, okay, here's all your buckets of income we're going to build out for you. So if you have this withdrawal strategy dialed in, it's the withdrawal strategy that people are the most nervous about. They don't know. They don't know what bucket to pull from, the taxable, the non-taxable, the Roth, or whatever. And learning that phase of life is a little tricky. So this is where a retirement planner comes in the right advisory firm for you. So I would implore people to take initiative, have these income plans built out, because I just sat down with somebody personally, a friend of mine's family member, and we did their income plan. And you know what? They were going to retire for 5 years at age 65. And I have them retire now at 60. And they're like, wow, I didn't know I could do that. And they didn't save as much, to be honest with you. A lot of people come in, they've saved $1 million, $2 million, $3 million. They only saved about $500,000. But because of the strategy we built in, it said, yes, you are okay to retire. So a lot of people are coming in and seeing us saying, can I retire now? I don't really want to retire now, but I just want to know if I turn in those keys to retirement and said, I'm over this job, I can.
Well, one of the things that becomes more confusing about this is if you look these things up, and I know all of you are out there Googling, I know that you're putting in things like the 4% rule and see what comes up. And then what's going to happen is it'll explain it just like Charisse did, but then you'll see William Benjamin, who came up with the 4% rule, now says it's a 5% rule. And then you'll see Dave Ramsey, who was out there who said, no, I think you can spend 8% of your money.
Good God.
You know, I mean, you get all of these conflicting stories out there. And I think that's so important to come in to see you and say, those are broad brush strokes. That's generic stuff. We need to get customized and focused in on you. And there is no better way to do that than just sit down and actually do the math on your retirement, find out what's going out, what's coming in, and what you want to do in retirement. That takes a meeting, and we will do that for you at no charge. We call it a complimentary retirement consultation. And when you go to our website, which is zinniawealth.com, you'll see that button. It's a gold box, and you can click on that. We'll ask you to put in a little information there. Our team will give you a call and say, okay, what was it on the show that you heard that you want to talk about? What are you concerned about in retirement? Is it running out of money? Is it Social Security? Is it health care? Is it taxes? What is it? Let's get it all out on the table. You can also call us 833-368-3680. All right, Charisse, one of the things about where to put your money in retirement is you talk about those three main things that we're concerned about: protection, income, growth. Let's talk about income here for just a second here. One of the ways that you've talked about you can develop income in retirement is using dividend-paying stocks. And that is a stock that pays you. It gives you money along the way. They share with you some of their earnings that they have in that particular company. Well, the chemical company Dow is a dividend-paying stock. And just recently, they cut their dividend in half. So if you were getting a 4%, now you're getting a 2% dividend. So I wondered, is that an isolated incident, Charisse? Does that happen a lot? Does that make you say, I don't want to use dividend-paying stocks? Or is this just something that happens and we live with it and it was a bad earnings report and that's what we have to live with?
Dividend earning stocks can be a great part of your portfolio, but you really got to pick the right dividend stock. So chemical company Dow is the ticker number, had a big cutback on their dividend, right? So in retirement, I prefer not to have the risky stocks out there because there's a high risk stocks that pay high dividends like 6, 7, 8, 9, 10, 11, 12, all to 20%. And then you have your little bit lower risky stocks that pay an average of 3.5 to 4.5%. So the companies, I call them the staples of our universe. You know, you got your Coca-Cola, you got your Colgate, you name those things that we're always using. And what happens is steady Eddie, I always say, wins the race. Those types of companies typically keep that dividend paying, that 3.5 to 4.5%. So what I've seen over time, and you can read all about it, companies who pay over 4.5% in dividends, they tend to, when there's hardship, balance sheets go down, et cetera, they will cut your dividend. And some people, when they're in retirement, they put all their money in dividend stocks, and all of a sudden, if they're heavy weighted into one and they cut back, they're not getting as much income. And then what they're having to do is pull from the account value, and maybe the account is down because the market's down. Now you're selling a stock at a loss, which is a cardinal rule. We don't sell stocks at a loss. I mean, that we've learned that in our entire lives. That's the worst strategy out there. So it's okay to have dividend stocks. It's the right dividend stocks. And people who can take risk and have time on their plate and they don't care if the stock goes up and down, they just want that heavier dividend, even if it goes down, you can carve that into your portfolio and your strategy. It just depends what kind of income you need in retirement. How much have you saved? What are your fixed incomes? Do you have a lot of debt? Like, what's our goal, right? So the right dividend stock is definitely going to be key in retirement. In my opinion, you can go a couple different directions. And we do that with our clients. And it's just one little piece of their portfolio so that we have that building.
Well, when a company pays a dividend, what is the reason for that? The company is trying to make their stock attractive to you. So if the dividend is 8, 9, 10%, does that kind of flag you and say, this company needs a lot of money and they might not be in really good shape because they're trying to get people to buy their stock to support their growth and get them going. And that might not be the kind of company that you want to invest in.
Right. I mean, for example, look at Verizon. It's bounced around from a 5 to 7% dividend to even higher at times, but the value doesn't shake out the way you want it. You want your value to go straight up, and it wobbles around and then it's sideways and it goes up a little bit. But here's the deal. If you're living on that dividend, they have been very consistent on that dividend. It is a riskier stock, but if you are reinvesting, here's the key to dividend stocks. If you are reinvesting that dividend stock to buy more of Verizon, for example, I'm not picking on any one company. What happens is if the stock comes down, takes a loss, your dividend's buying that stock at a lower price, which is awesome. And when the stock goes up and you get paid your dividend, it's still buying more stock at that price. And what happens is you compound that stock. And now you had 20 shares of stock and now you're at 40 getting a dividend. So there's some value to a dividend portfolio and a stock portfolio like that, which we do put into our portfolios because it's just another little piece of the income plan and growth strategy. Even if you see that stock sideways for 5 years, sometimes there's that value. You've got to just look at it differently. And the other reason why I do like dividend stocks specifically, let's say you're younger or you don't have a 401k, or you have an employer that you're putting a 401k into and you don't get a match. A 401k should give a match, but not all employers do that, right? So a dividend stock, I would call that your sort of wonky 401k with a better taxable strategy because you get this stock. Let's say you get Coca-Cola, it pays a 4% dividend, and you put $100 in there and you get this 4% dividend. You're getting a match. It's free money to you. So I think it's another value add when you're being strategic in your tax strategy in the future also. But do know when you get dividends and it's not in an IRA or Roth, it's in a brokerage account, so you will have capital gains at the end of the year. So we got to make sure the right dollars are parked in the right buckets. So that's really important.
Well, one word that we don't use very much here on the show, especially when it comes to markets, very like stocks and things like that, is the word guaranteed. Guaranteed lifetime income. That comes from insurance. That comes from the insurance world. That comes from annuities, that kind of thing. A dividend paying stock is not a guaranteed piece of income. It can go up, it can go down. And that is something that we realize. How much do we want to play in that stock market? How much do we want to play in the up and the down? And maybe that's something that you have a conversation with Charisse about. Are you comfortable in that area or not? Or how much are you comfortable in that area? Let's have that conversation. Let's talk about your retirement and get something down on paper today. Give us a call. Give us a look on our website. Here it is, ZinniaWealth.com. ZINNIA Wealth.com. And there's a gold box there. It says complimentary retirement consultation. When you click on that, it'll open up a field so you can put a little information in there about you. Our team will call you and say, okay, what is it that you'd like to talk about? What are you concerned about? What are you worried about? How can we help? You can also bypass all that and just call us. 833-368-3680. 833-368-3680. Charisse, that is all the time we have on this one. I'll give you the last word for today.
Well, thank you all for tuning in again. Live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC. a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.